bit of a shortcut way, or sometimes shortcuts are longest distance between 2 points, but it just depends on what you're comfortable with. Okay? That's that's as far as some of the basic applications that I use. That's kind of pretty much it. I can kind of go through my chart setups and how I like to, from day to day, how I look at charts. If if that interests you, give you maybe a little bit of a warm up before we get into, just so that you know maybe some of the things that how I'm operating when we get into some of the sort of the theoretical and the application on Sunday. One of the things that I don't want to do is you have your way of trading, and I have my way of trading. Mark has his way of trading, and I want to be very careful about creating confusion. Between Mark will instruct on certain specific methods and a specific plan that he uses for his trading, and I'll go through the method with which I trade. You want to be very, very careful as a trader not to take a mistake with developing traders, especially is they get so much information and they're trying to do all of it. And if you're not clear, if you're not absolutely clear in how you want to approach the market, you want to be very careful. Okay, so it's a lot about looking at specific methods, and you'll find that, let's say, for example, you like the way Mark trades, which I think is excellent. You apply those methods, and maybe you've got a few quirky things of your own. Maybe you pick up 1 or 2 things from me, and then maybe you want to include those, or and so forth. But it's really important that you become an independent thinker. But I really want to be very careful about not creating confusion. All right, and so I think it's good that Mark's going first, because a lot of you are familiar with his stuff already, and then I can kind of work with that. And because I don't want you to feel as though I'm enforcing my methods on you, and I think mine are pretty simple anyway. You'll say, "Really? That's all you do?" Just want to make that clear, and I'll probably repeat myself again on Sunday in that regard, because there will be some other people here as well. All right. So as far as just the navigation throughout the day, this is kind of the way that I'm thinking. Is normally, like, one of my instructional classes would take about 2 days plus a couple of hours, and I could probably even go longer. So Sunday I have somewhat limited time. That's why I think maybe I can just cover some of it now, so that you're already familiar, because I may not have time to get into a lot of details, because I could sit and talk about trading for like 2 weeks and it all be new stuff. When the markets, what I'll do is I typically have a good feel for, I think, probably one of the most important aspects of trading is understanding the market that you're trading. Be it the instrument or the market, but have a real good feel for the market you're trading by understanding the underlying drivers of the market and the fundamentals of that market. However, you still have to have the wisdom or the discernment in order to distinguish between what's important about the fundamentals or what's not, because as you know, fundamentals can be going this way and the chart can be going that way. And we all know that. There's a complete divergence between the fundamental aspects and what the market is actually doing, right? But when you have fundamentals and technicals moving in the same direction, it's what I call a high probability trading environment, versus this one, which is usually often lower probability. Sometimes one can lead the other, and sometimes and so forth. We all know this from sitting in front of charts and watching the response to the market to certain events. But I think it's important to understand some of the fundamental aspects of what's going on in the market. And based on my foundational understanding of some of the fundamental aspects that are happening in the various areas throughout the world, then I obviously look at the charts just with that little bit of a gut feel of knowing what's going on, and see if the charts are either kind of agreeing or disagreeing and so forth. But I like to watch the daily chart, and the 1 hour charts I really like. For my entries, I'll zoom in on the smaller time frames, like the 5-minute and the 15-minute charts, to have a real close eye on price. And also, so for intraday trading, I like to of course, I'll look at the daily chart and then focus on a little bit on the 1 hour chart, and of course go down to the smaller time frame. But if I'm trading more position type swing trading or longer term trading, then my primary focus is on the daily chart and some of the underlying fundamental aspects. So for example, right now, in the foreign exchange market, there is a heavy focus, market sentiment is really on the higher yielding currencies. Higher yielding currencies are moving, and there's absolutely no dispute. The high yielders are moving, and money is moving into the high yielding currencies. That's a fact. That's what's driving the trends. So understanding that, now we go into our technicals to find our entry points, establish our strategies, and employ our position management once we are in the trends. Okay? Yes? Sorry, what's your name?
Warwick.
Yeah, can I see how you spelled?
I'm sorry.
Oh, okay. Wiry. Okay.
How can an ordinary trader find out where the money is moving if they're not subscribed to your?
Yeah. No, I'll give you places to go for free. Where you can go for free, and it'll take you 5 minutes a day, and they'll give you an overview on what's moving the market. Okay? I'll show you that on. I can show you that on Sunday, or actually, it might even be in the book. But what we do is the objective is to give you as much as you can for free, right? There's no sense paying for something that you can get for free. There's a lot of information on the foreign exchange market, and the basic. Getting an understanding for the basic fundamental drivers that are existing in the market this week and today specifically, what events are coming out, and there's several places you can get that for free. Yeah, so we don't want you to pay for anything you don't have to. Okay? So with that, then what I'll do is as these markets start to move, because I don't like to be confined to just small pictures, I like to see what's going on in the on the larger spectrum. So I'm constantly scrolling through charts. Be it if the market is really moving and if there's a lot of volatility, I'll scroll from like a 60-minute chart. So for example, let's take that Euro chart we were just looking at. And it's very hard to see much right now, right? We're dealing with limited information. And so I would simply either, compress the data, as I showed you earlier, or just simply move to a higher time frame to see where we are in time and space, right? And so, for example, here, because this is a pretty choppy market, and what I would do is I would obviously want to move to a daily chart to see what's happening on the larger time frame. And here we see, obviously we have much more information, and this explains the consolidative period that we've just viewed. Price is slowly trying to move higher, it's struggling. And in my opinion, we're forming what's what I call a triple B reversal. But this just gives us a nice view as to what's happening and allows us to, of course, dissect what's happening on the smaller time frame. Okay? But when you start to have a lot of volatility, so for example, if the market starts to move and we start generating new highs, you really have no price reference points on what's happening from in a larger perspective. So obviously you just scroll to a larger time frame to see where you're at in time and space. And I'll do the same thing with the very small time frames as well, with the 15-minute and 5-minute charts. So just to give you an idea, let's have a look at price action from today, for example, with the British pound and the euro. So let's just, actually let's do this. Let's deal with these yen crosses from today. Okay, let's just tile this. I'll give you an idea as to how, because we had volatility in the yen crosses today. So let's say, for example, here's the pound-yen currency pair. Let's just draw some simple tools on here. And here, this is previous resistance, now marks support. And what the market did was this, was it attempted to make a new high and it got rejected. Okay? And as price moved below this trading range low, I want to see I want to know where the next point is to stop or maybe to make a trade, because the trend is up. I may want to go long here. I've actually in fact been waiting for big pullbacks in this pairs. But if I want to go long here, I pull my Fibonacci's and so forth. But here, this is a daily chart, and we see price coming down to this level. Well, I'd want to see what it looks like on a smaller time frame to determine whether or not I want to make an entry. So let's say, for example, the 15-minute chart. I want to see what it looks like. And this is where our low has been established down here. And we see it took a very sharp bounce at the start, which is, with this currency pair, is very, very anticipatory. If we look at the difference between the low and the close. By the way I did this, I use candlestick charts just because they're visually friendly. I don't trade a lot off candlestick patterns. I find them a bit lagging based on the way that I trade. I acknowledge them. I like that the candle pattern forms after I'm already in the trade to confirm, okay? But I'm not I'm not into chasing the market so much, which you'll learn. But for example, you see how price came down. We know it came down to a key low on a larger time frame on the daily chart, for example. So by the way, what I would do is if I just want to have a quick look at the valuations behind this bar, I just simply place my cursor over the candlestick, right click it, and it gives me the information on that bar. Okay? Can you do that with the bar charts too, yeah? You have to have a sharp eye with the cursor on your bar charts.
Chris, I got a really dumb question. You got a monstrous tail on that candle. If you were to draw a fib off of that, are you going to use the body or the tail?
I typically will use the tail. I typically will use the wicks.
A monstrous tail?
Yeah, mm-hmm. Yeah. There's quirky little things. Pardon me?
Could have been a fat finger, a mistake.
You mean like an errant tick?
Yeah.
Or a bad tick? Well, this is a 15-minute chart, and I understand this currency pair, so it can do that very easily. But let's just look at the valuation. So the low goes down to 48.59, and then it closes at 49.31. Okay, this currency pair can do that no problem, especially after this aggressive a move. It can do that no problem. Okay, and it just bounced here, and then it ended up, there's different quirky little things behind this. For example, as it moved up, it would have gapped, and the bank feed would have gapped. And so often you see trailing deals that will go down and fill these gaps, and that's just a side quirky thing that we see. But those are other details. So then it just came down, filled the gaps, and bounced, and that level held. Okay. But if I was looking for an entry down here, I would look on my smaller time frames. Based on this bounce, it looks to me like it could, in the next session, continue through that level.
To what?
Pardon me? It can continue through that key level of support that we have seen there. You see this level of resistance become support. The next session could start to move through, because the bounce was a soft bounce. All right. But you're all probably pretty familiar with, with just sort of like top-down analysis type, type overviews. Yeah.
Well, just a general question, because you're talking about sort of from a fundamental standpoint, getting a macro view, higher yielding currencies are going to attract money from lower ones. But, for example, do you trade your reports, like the non-farm payroll type stuff?
Yeah, that's kind of a strategy question, but I won't stand in front of non-farm payrolls. I won't do that. What I will do with major economic reports is I don't trade them like right after the fact, see what the number is and see what price could do. I know people who do that successfully, but I know most people who do that unsuccessfully. I know more that do it unsuccessfully than do it successfully. The ones that do it successful are very good professionals, and you need a very good dealing. You need very good prices and a good facility to do that through in terms of who you're dealing with. What I will do is the way that I trade is I'll do things like this. Okay, for example, let's look at today's not a good example, but I will do things like, let's look at today as an example of what I was looking for today. Okay, this kind of gets into, again, a strategy question, but also I guess it still shows some of the applications of the software. But and again, if you guys have more questions on the applications, feel free. But I'll show you what I was looking for today. Let's go to a let's see what we get here. This is a British pound. Let me just make this more viewer friendly for you. This is a British pound 60-minute chart. Okay, and where I was looking for my trade today, for example, was this is kind of how I combine the technicals and the fundamentals. So let's take this out of here. Let me just clean this up a bit for you so it's not so confusing. So I'm just whoops. Go away. I'm just taking off, some of the tools. For example, this morning, or last night, basically when I went to bed just before London opened, which I'm usually awake until into lunch hour of European session. But before we, as I mentioned, we still got to talk about grids, right? About how we got these grids. We moved into the new day. You see 0-100 hours GMT right there. This is a 60-minute chart. Okay, we're moving into the new day at 0-100 hours GMT. That is the lowest volume period in FX. Is typically 0-100 hours GMT. Okay. So we move into the new day, and then London opens. When London opens, we start to see liquidity get pumped into the market. Basically when Frankfurt opens. Depends on the economic reports that are coming out in New Zealand, Australia, and Japan. So if there are a number of reports coming out during that time, we might see some liquidity or some volatility in and around that time. And the patterns in and around that time I'll talk about on Sunday. But I just want to give you an idea as to based on this question on economic reports, is what we're getting at here, okay? But I'm just trying to lay some groundwork. So we see the European session open. So all we're seeing is some natural liquidity from parties or commercials that don't really care about the fundamentals that are coming up. They need to make commercial transactions. So liquidity gets pumped in the market. Orders are being placed through the dealers at the banks on a global level. So we start to see some jiggle in the price spread. Okay? And what I was doing was I was waiting for price to come down either to this level, to this, I was looking for a balance at two levels basically. Right here, which is around the 204, is around 204.20 area at the 62 retracement and the extension of this downswing. And then also between 203.80 and 204.100, this level of resistance and the 79 retracement from the recent upswing. Okay? And that's where I would look to buy, because we're in an overall uptrend. So generally the market is generally or largely bullish on this pair. So technically I'm trading with the trend. I'd be trading against the move, but with the trend. So that's where I'm looking, and I may place forward orders. I also consider range and all that, which I'll cover on Sunday. But what happened was today we had an economic report out, and this is quite important because you want to be careful not to stand right in front of economic reports. So what I would do is this: we had GDP was coming out, and there was forecast for GDP of 2.9% growth year on year, and 0.7 quarter on quarter. Okay. 2.9% is a lot. That's a lot of growth, especially when they want to control it at 2.0. Bank of England wants to control it in around 2.0. So what happens if, this is the way that I'm thinking now, well, what happens if it comes out at 2.9 or higher? Well, then the market's going to say 2.9, 3.0, holy cow, you know what? Bank of England's going to raise rates. Well, because we're in an interest rate environment, what's the market going to do? What's the British pound going to do? It's going to go up, right? So where the interest rates are moving higher, money is flowing into those regions, and that's what's driving the trends. Trade with the flow of the money. Okay? Well, since I wanted a retracement here before it keeps going up, of course it's not going to do what I want it to do. You have to sit back and watch. So what happened was here's when the report came out. It actually, me and my creative little mind says 2.9, that's a pretty heavy forecast. It could surprise to the downside at 2.5 or 2.0, which could drive the pound down. And so, anyway, it came out at 3.0. So what it did was it drove the price up. Naturally, dealers are going to bounce here, and then it continued to push price up, okay, because it slightly exceeded forecast expectations. But this is why it's important because I was looking for a potential failure of this high. So the way I would trade a report, for me there was no trade here. What I was looking for was this. I was looking for price to come up, test this high, fail, and if that failed, we could have saw price really go down, really, move down. So for me, I was either looking for a failure of the high, or if price came down to one of these two levels, I was looking for a buy. Okay? So to answer your question on economic reports, I like to wait for the report to come out, and then I'll watch what price is doing, and then look for my technical levels and trade off a technical level.
When I look at what you're showing here, I mean that shows the exact same thing that's happened in all the markets. I'm looking right here at the Russell, or the same thing at the S&Ps. That's the exact same thing that they did. They came down here at the 20th. The only thing is that's leading it. It looks like it's on the 22nd. So let's see what this does and see if it follows it.
Yeah. Yeah, I don't look too closely. I wouldn't know. I don't look too closely at the relationship, or I don't really look at all the relationship between the Russell and, some of the various currencies and so forth. But I'm just saying that's sort of the question. The original question was about economic reports, right? So, but then I understand how the dealers work, and what I would look for then is the high held. Okay, I look for a failure of the high, price to move through. Thinning volume, then price. Because what the dealers are looking at is they're looking at that right there. And you know what? That's not rocket science. They're looking at that price right there. Okay, so now, and I look for anywhere between the bodies and the end of the wick. Okay, now they're holding that price right now. I look for a collapse of that price, because if that price collapses, that means the bulls got trapped, and the bulls start to bail, then we see price run south, okay? Yeah, and I'll get into all the details, some of the details on Sunday and so forth, and then Monday, Tuesday, when we get into, this kind of stuff, I'll get into a lot more detail. Okay. Pardon me?
They all get stopped out. Everybody runs.
Yeah.
That's good, because that means it's going to go back up.
Who knows?
Chances are.
Because some people didn't buy. People bought. When it got to this, like a wash and river. when it got to the top and took out all the stops, we are at that.
Yeah, I don't know if it was so much stop running on the top there or not, because the trend's pretty strong. Usually in the kind of trend that we're seeing here on the pound US dollar, it's normally a case of this. Let's look at, do you guys mind that I'm getting into some of this, or it's okay? Okay. So this is a, just resize that window. This is a, a pound US dollar chart. And just to go off of what I had explained earlier, oops. What I explained earlier was that there's two factors here. Number one, there's what's sort of the forecast in the U.S. economy? What are some of the factors affecting the U.S. economy in terms of the perception of the U.S. economy, or what they're forecasting for, interest rates? So housing slowdown, which can slow down inflation, right? So if inflation slows, then they'll loosen a little bit. They'll loosen, so maybe they'll hold on interest rate hikes. They might cut. Right now, it's a bit kind of open. So really, there's uncertainty around what's going to happen with interest rates. But right now, with all of this, for example, today's numbers with strong GDP in the UK, there's two factors here. Number one, it's a US dollar bearish sentiment in the market. And there's in this particular case, this is the British pound US dollar chart, so there's a very strong sentiment in the UK right now, probably overpriced, but they're really pricing in growth and potential interest rate, because they're pricing in now what they anticipate in the future, so interest rate hikes. So what happens is this kind of trend is often driven by these factors, and you probably see it in the futures markets as well. It's not so much that there's extremely aggressive buying here, it's also a consequence of a lack of interest in US dollar buying. So there's really low interest in US dollar buying, so that lack of liquidity on the US dollar long side, or it permits bullishness on the other currencies to push price up. Okay? And those are quirky little things that I want to talk about, share with you as well over the next few days. It's not as though really it's not that it's a totally US dollar bearish scenario. It's that more that there's just no interest. People don't want to get in the way. So it just permits price to push. Do you remember, those of you watching FX, do you remember Thanksgiving? Anybody remember Thanksgiving? Okay. That's a classic case where the rest of the world doesn't care about American Thanksgiving, but Americans sure do, right? And people walked away from their computers saying, no liquidity. Well, you're darn right, no liquidity. Now watch what happens to price, because there's no liquidity. Okay? Now look at the volatility, right? And that's why I like to trade around Christmas time. While other people are shopping, I sit in front of the computer, But so that's kind of like when these trends happen like this, it's often, so you want to watch okay, let's watch some of the US data. Let's see if some of the US data becomes seemingly strong or a little bit stronger. Then we could start to see, maybe one or two positive US data events come into the market and we start to see some choppiness. And then all of a sudden, that's interesting, we're starting to see a pattern of strong US data come in, but it's also, human beings are extremely fickle. So, sure, right now they care about how interest rates are being raised in the UK and all that, but then, the market's got ADD, 1 minute they're looking at, oh wow, look at this, they're raising interest rates over here, boy, cool, let's buy, let's get in these trends, and all of a sudden the market, something else catches their attention, they completely forget about this. It's about the shift in market sentiment. So if you pick up on these little things, then boom, and you pick up on the technicals are what you use to enter the trade, but you've picked up on the fact that there's been a shift in the ADD market over here, and then you start to look for the opportunity, or you look for the patterns to confirm it, right? And is that making any sense at all? Yeah? So, but anyway, these are just like small, tiny little pieces of a really, big pie, but I know it's kind of we kind of ran out of stuff to talk about on the software, so.
Since you're in a bull market there's not really buying driving it up. Is that something where you would start looking for a reversal?
There is buying driving it up, but it's more like the buying. Keep in mind that the liquidity curve is not constant, right? The liquidity curve is not constant. It's always like when you look at a dealing desk. I've been in a number of the dealing desks, and it's really hard to get in there. But I've been at a number of the dealing desks and the FX desks at major private banks, and when you watch the dealing, you'll see a change in the flows. Okay, so you'll see order flow come in. So for example, let's say the sentiment is up, like in this case, you'll see the order flow come in, and like in this case, there's just no interest in US dollar buying, so you'll just see order flow come in, push price up, and then because then liquidity will drop a little bit, so price just drops. Okay? That's why you have your bearish candles. Price drops, and then because quite often you'll have an entity who's got a certain order size that they want filled. They'll drive price up to a certain point, and then they'll say, well, we're not chasing our own price that we've created. So then they'll wait, and they'll have more orders down here. The price comes down, and more liquidity gets pumped in, and then you have some other people maybe chasing. So the liquidity curve is constantly moving, and then sometimes you'll see gaps drop, and you can see in the order flows that come through the bank. It's called order flow, or the order book, and these orders actually start lining up before the session starts. And you start to see orders lined up in certain volume of orders. There's like literally a list, client numbers and lists, and you can see the order flows, which is why, like for example, at the Open of London, session, you'll see price pull in one direction and then drop. Like I can literally call the bank and I can say, okay, what's your order stack look like? And they'll say, well, look, we've got 20 bucks here, 50 bucks there, a yard here, 20 bucks there. And so what you want to do is you want to place your order if you're anticipating price to move up a bit before it changes direction. You want to put your order just below one of the largest orders on the book, because if it hits the order, it drops, and it maybe at least pay you like 20, 30 pips in case it keeps going up. There's no guarantees in this whole thing, but it just gives you an idea of the gyration of the market. So when you see the order book, or have an idea of what the order book feels like, then you can get a bit of a sense. I mean, those opportunities aren't that often. I'm just saying that's just to give you a bit of a perspective as to what that looks like inside. So and quite often when you see these trends like this, you'll see that obviously the flow is up, but the question is where do I get in? I mean, the trend is so strong. Where do I get in? That's one of the biggest challenges when a trend is this strong, especially when we saw the U.S. dollar really falling back in 203, 04. It's like where do I get in? But we'll look at that in the technical aspect, on the days, forthcoming days, But does that help at all? Yeah. And you'll see, that my charts are typically fairly simple. I go more on pattern recognition, and like the Canadian dollar, for example. I mean, it wasn't rocket science to me. I'll show you a chart, for example, on the dollar Canada pair. I'll probably go through a lot of this again in the future, but like I say, I'm normally dealing with more time, so maybe we can get a little bit of head start. So we'll take a dollar Canada daily chart. I must have changed it here somewhere. Yeah, I'll just change it back. So dollar Canada was very interesting because right here, where we had, so for example, where we had this kind of just this basic head and shoulders, the top of this pattern was from the dollar Canada base back much earlier in the year. This is the completion of a Gartley pattern on a large time, on the daily, weekly chart. It was the completion of a Gartley. Okay, so, and you see this price right up here, this right shoulder here. Where did that right shoulder come to, Fibonacci-wise? Came to a 79, right on the 79. And it's on a daily chart, so like for longer term position traders, for people who don't want to, lose sleep and all that, and just want to look for major shifts in, in certain currency pairs, maybe for diversification of your portfolio, or maybe for, things like that, low geared or no geared positions. Look at daily charts and just keep a feel for the fundamentals. Look at daily charts and move your cash. If you move unleveraged cash from one currency to another and you get 300-400 pips and move it back, then you can do okay. But that was a perfect. The top there was a completion of a Gartley pattern. Like it went to the extensions, and then it formed a full reversal pattern on a large time scale, and then changed. It actually, for the Canadian dollar, I was very surprised at how aggressively it rallied, like the down move. The Canadian dollar rallied against the U.S. dollar. I was quite surprised because it doesn't normally behave that way. But there's all kinds of fundamental reasons behind it. Price of oil, precious metals, interest rate factors, and all that. But I can get into it if you want. I mean, heck, we got time. Unless there's certain things that Mark wanted to cover as well.
No, I was just wondering if anyone or everyone needs a break.
Do you guys have I? Do I need a break? Yeah.
Yeah, and we can decide whether we're going to get into tool setups or if we can. I mean, like my stuff, I see.
Our retracement levels. I'm just going to draw like just a naked Fibonacci level on the blank screen. Let me actually just move the screen over. I'll just draw just a naked Fibonacci level. Okay. So, for example, if we have a price swing, okay, let's just say it's from sorry. Let's just make this make sense here. So say we have a price swing from this low to this high. The market retraces 38, 50, 62%, and this is 127% extension of this swing. Now these are different than Mark's, okay? So I'll show you the parameters. So if we edit this, the way this looks is I have the 0 and 100, okay, this is 0, and because we're retracing backwards, we're retracing 38%, 50, 62, 79, 100. So I have a 0 in there marked in blue, a 100 marked in blue. Then I have 0.382, 0.5, 0.618, 0.786. Okay? And then to get these extensions, the way the rhythms that I use, to get these extensions I use minus 0.27 because these are retracement values, right? So you're actually retracing negatively, right? Mark does it the other way, which in my opinion, I'm going to start looking at that more closely, because if the market continues right through 100% retracement and continues further, those values are very good, by the way. But I'm using more like for the Gartleys that I look for on the longer term, I use this type of retracement level or extension level. So it's minus 0.27 and minus 0.618. And because it's a negative, it's a negative move to the retracement. You follow me? All you have to do is, I think in the book I've got a picture of it, and it's got a list of how you would input it here.
So it's a 0.618 of the move from the high to the low, the negative.
This would be 0.27 or 27% of this larger swing. This would be 27% beyond the high, right? And this would be 62% beyond the
How
high.
did you get the 27%?
Pardon me?
What was the basis for choosing 20.27?
The Fibonacci number, 127%. Yeah. Okay. And those are the inputs. Those are the inputs that I use. And there's a picture of it. I believe there's a picture of it in your books. So this will all make sense to you after Sunday. It'll make a little bit more sense.
What page is that on?
I don't know exactly what page it is. Let me have a look, quick look here. It is I'll have to look for it. Actually, I don't know. I'll have to look for it. Unless it's not in there at all, unless I forgot to put it in there. I may not have put it in there. Because what I did was I went through, I've got like hordes of slides. I went through them and just tried to really put a summary, bit of a summary, or just, for this manual. So otherwise your manual will be quite thick. Okay.
What's the level that it would trace back to from the high?
Here?
Yeah.
This is, for example, the levels that we have is there are other Fibonacci levels that you can use in between, but I don't like the shallow ones. The shallow ones make me nervous, based on these types of, this is obviously, we're only seeing one little snapshot tool, but this is used in combination, of course, with other tools and patterns.
So it's
But
0.618 of. Right click on it, it shows the different levels.
Yeah. Let me see here. Well, if you put on edit, for example, it'll show you the levels. But yeah, I typically don't identify the levels, show levels. Show values.
Yeah.
I typically don't use them. But this would show as minus 0.27 and minus 61.8.
It's in here.
It's in there? You found? Okay.
So that is a
Pages aren't
That is a
marked.
Gartley panel, right?
This isn't a Gartley. This is just an upswing. But we'll cover Gartleys in detail.
But it's sort of the same information.
I'll show you sort of how I arrive at those on Sunday. This is just looking at kind of a standard upswing. Okay. The reason I don't put values in there is because I know where the values are, right? So, yeah, okay. Did you want to go over
Sure,
yours?
I
Or?
want to swap over to my computer then,
Sure.
I guess. And I think
Any other, do you guys, while I've got this set up on my computer, do you guys have any other questions maybe before we switch it over to Mark's? Any other Yeah. We'll see this, we'll see quite a lot of this, like on Monday, Tuesday, and we'll just go over in detail. We'll kind of give you the overview on Sunday, and then we'll start to pick it apart Monday, Tuesday. You know, if it's slow, the live trading is slow, then we can just start to go in there and pick it apart and, you know, okay?
And we're not limiting any of the tech stuff to today, you know, either. I think that's basically what Chris is saying too. You know, if you guys don't have questions about this second, we can talk about other questions about how we have our tools set up and stuff as we have examples to use.
There's a lot of it you don't really know what to ask, right?
Right.
And there's a lot of gaps, so it's a question of when you get more information, you have more to draw from in terms of knowing what to ask.
Okay.
And we don't know what to say because we haven't, same problem.
Right. So, alrighty. I use 4 tools primarily, 4 Fibonacci tools, and you guys have. I mean, some of you have worked with me before, and you have your tools set up that way already. I have the layouts in the book. Also, the workbook, by the way, my workbook materials are kind of thin because since we have such a nice small group, I wanted to be able to generate more materials together while we're here, meaning that, like a lot of example charts and stuff, we'll work on charts together tomorrow and on Monday and Tuesday, and we'll be printing those out. And I'll also email you PDFs. So the workbook materials will expand as our time together goes on. Meanwhile, you do have the way I have my parameters set up for the various tools. I will go over it though, just in case you want to match my setups. The first tool that I use is the expansion tool, which my tools are moving around a little bit here because of the screen resolutions. This guy up here, expansion. Okay, can you see where that is, or should I use a pointer? So yeah, it's the one. It's next to retracement. Okay, and I have my parameters, you know, the menu thing shut off, so I'm going to just draw one and just to get it on screen so I can show you how I have it set. Find a good example. It's real simple. There are a lot of different options in this tool, and I generally just use one setting here, the value of 1, which is 100%, 1. I have the others shut off. The only other setting that I use here occasionally is 1618. I have that shut off by default, and I'll activate that when necessary, and that's maybe once or twice a month. Do I need to use that 1618? This is the expansion. The difference between retracements and expansions, just to give you a little backstory here, expansions are done from 3 points. With a retracement, you're taking a low to a high or a high to a low, and you want the Fibonacci ratios based upon the distance between that low and high or high and low. With the expansions, the way this tool works is you're taking, let me get rid of this guy. What you're doing is you're measuring a prior swing, like a low to high, and projecting from a third point. So in other words, what I'm doing here to measure the strength of this downtrend is I'm measuring a prior corrective bounce and projecting from the lowest point afterwards. That's what the expansion tool does for you. And because I want to have an exact measurement of a prior corrective swing, that's why I'm using the value of 100%. And I color that, you can choose your own colors, I just keep that colored red because to me, the expansion is a stop sign. That's where, if the strength of the trend is going to maintain, I expect the market, a similar rally, to stop at that point. So the expansion tool I just have set to 100%. A couple of the other settings in here, I do have show values just because I like to see when I have other Fibonacci levels overlapping that point, I want to see what exactly is coming up to judge the strength of that cluster, the strength of that, of the various levels that have confluence there. I like to use extend to end, which just means that it draws it all the way to the end of the chart, and I'll show you why later on, but that is what I use. Keep live. Keep live is a very valuable addition. It's also in the retracement tools. That simply means that if we make a new high or low, the level will adjust automatically. In other words, here I took low to high, projected from new low. If this swing continues downward and violates this low, this level will move down correspondingly and project from the new low. So that's a very powerful way to not have to. If that didn't happen, I would have to erase all my resistance and start over from the new low.
That's being magnet to,
No, it doesn't have to be a magnet to auto to do that automatically. I'm sorry? Sure. Okay.
Is it a-
No,
Some of the lines aren't showing on here.
I'm not using the retracement tool. I'm using a tool, the expansion tool, where I only have one line set to show. Okay? I'll show you that again. Okay, this is not the retracement tool. Okay, retracement tool would be that icon. Okay, like the one that Chris was showing you, it's the retracement tool. I'm using the expansion tool, which is next to it, or if you have your toolbar vertically, it's right above it. It looks like that. It looks like, I don't know, something that Carlos thought would represent it well. But it's not the retracement tool. And you see, here are the options. You see how I have all these unchecked? The only one I have checked is the value of 1. That's why you're seeing only one line project on the chart. Okay? And what that does, like I was saying, that gives you 3 points to deal with. If I switch back to arrow, by the way, and just click on this level, it'll show you the 3 points that were used. The significance of this level is you can kind of see that this is a kind of a very loose downtrend, very choppy, not choppy, but very volatile downtrend. We're making new lows. So all this is doing is measuring this low to high, projected 100% from this low. So it's this distance. In other words, if I expect this downtrend to maintain at the same pace and strength, I wouldn't want to see that level violated. It's sort of a more advanced way of using trend lines, basically. The keep live element, what that does is, this is projected from this low. If we make a new low, this is going to bump down and project this 100% value from the new low. Because this number, 853.30, is only valid from this low. If it didn't automatically update, I would have to erase it and project it again manually from the new low. It takes a lot of time. There are only a couple of packages on the market actually that will automatically update it for you this way. That's the keep live. The magnet, I'm glad you mentioned the magnet. I use the magnet a lot. The magnet is this guy here. The reason I use the magnet is because I'm projecting these levels so much and so rapidly during the day, because personally I'm doing a lot of charts. You don't need to, that it just makes it easier. I'll show you the difference. Easier for me anyway. With the magnet on, you see how you get this red highlight to a bar? So in other words, I can be anywhere below this low. See how my pointer is anywhere below that low? All I have to do is click, and it's going to select that low, drag anywhere above that high, and so on. That's a lot faster to me because I want the exact number. If I did it without the magnet, I'd have to go, okay, let me get right to this low, and now get right to the high. And you see I'm a little bit lower than that high, and I'll bet you I'm going to come out with a different number, 853.10. I'm off by a couple of ticks. When you're trading intraday on some of these fast markets, that makes a difference.
When did that show in line with the United States?
Because you have the baseline showing. Here, I'll show you. Again, this is how I have my tool set. What you're talking about, I saw it on your charts before. That's a good tool also. You have show baselines selected. You see mine is turned off. See this? Show baselines?
I lost my chart. I couldn't get that chart. I don't know what I got to do.
The chart or the dialog box?
The dialogue box.
Okay, draw another expansion. Right-click it and hit edit.
I understand the problem. How do you do it? For another expansion?
Right. Just even a nonsense one. You don't have to do it correctly. You just want to get one of those expansion lines on the chart. And then right-click it and hit edit. Now, let me show you the difference. If you match my settings, it's going to come up the way mine came up. What we're talking about here is the difference between having show baselines on. Show baselines will make it look like this. And all that does is it shows you the tracery of what you had done. Okay, it shows you the low to high from the new low. The thing is, on my charts, I do like 10 of these. So I'd have so many lines. When you're first learning how to do this though, when you're first learning how to project these levels, it can be handy, it can be helpful for your educational process to leave show baselines checked. Because that way, I'll tell you, give you an example. Let's say you had accidentally done this. Okay? Then when you say to me, Mark, my number isn't coming out the same way your number is. Well, if you leave show baselines on, we can see why it didn't come out the same way, because you missed and didn't choose the actual low. Okay? So that can be a good, handy educational thing to have. When you're actually using this in trading, you probably will want to turn show baselines off, because it's just going to have so many squiggles on the chart that you don't need to have. And frankly, you can get the same information, like I said, by switching back to the arrow. Just click on the level and it's going to show you that you went there to there from there. And you'll recognize immediately that you missed the actual low. And we all do that at times.
You go from the arrow to the magnet and back?
Excuse me. What were you saying?
From the arrow to the magnet and back?
Once you turn the magnet on, it stays on until you turn it off. You can just activate the magnet and leave it on.
Okay, what is the arrow then?
The arrow. This arrow?
Well, where you're pointing to the different, the tops and the bottoms, and you're showing the one on the left where you have missed the bottom. But instead of the show.
Oh, okay. Well, that's just changing back to here. I'll show you again. Let me just say I just chose the expansion tool.
Right.
Okay. So I'll draw this now. Again. And I just switched back to the regular pointer. In other words, the pointer that's over here.
Oh, okay.
Okay. Or if I don't want to reach across the screen. See, sometimes I do the shortcuts with the menu because I'm dealing with multiple monitors, so I don't want to go all the way over there.
Yeah.
So I'll just right-click and say normal arrow, which is exactly the same as hitting that. Okay. And then if you click on the line, it's going to tell you what you used, what you did. Okay.
The black background show base doesn't tell the show base.
You have to change the color of your trend line. Draw a trend line, change the color of the trend line to white, or use the style menu for the style tool that Chris showed you earlier, and the baselines will show then. The baselines are tied into the trend line color. Okay, so that's one of the main tools I use, and I just use that value of 1. Okay. By the way, maybe I'll show you this with the retracement tool. It'll be easier. My retracement series is slightly different than Chris's. And I'll just do a little one, let's say here, low to high. Okay, I use these values, 0.236, which is a very minor level, but I consider it valid if it's overlapping other stuff. 0.382, 0.5, 0.618, 0.786, and then for my way of doing this, instead of using those negative numbers, the 0.27 and all that, I use extensions of 1.272 and 1.618. Okay? And again, these are color-coded. The reason they're color-coded is just because I want to be able to see at a glance. Bless you.
Thank you.
I want to see at a glance if I have a pink and a blue and a red, and they're all overlapped, and they're so tightly overlapped that I can't even read the numbers. I know immediately what the strength is of that support or resistance zone. So I have those colors set that way. Anyone's welcome, of course, to choose the colors they'd like to have on there instead. I also have 2618 available. When I say available, what I mean is I don't have the box checked to show that all the time. I will use that under specific circumstances, and I'll show you what those are over the next few days. 2.618. If you look in the workbook, I have a screenshot of this exact setup there, so you can see what the deal is. The one difference, though, between the screenshot I have and